1. Introduction. The Retail Illusion. You are staring at a screen filled with, red and green boxes. The price goes up, you buy, and suddenly, bam, a massive red candle just wipes you out. It's an incredibly isolating feeling. You're looking at the chart, you know what the shapes are called, but you don't really understand the underlying story it's trying to tell you. If you have ever stared at candles like this and felt completely lost, comment "why" down below, so I know I'm speaking to the right people. Because it really is profound, that feeling of isolation. You watch your capital disappear, and the screen, well, it offers zero explanation. Exactly. It just keeps blinking, totally indifferent to the fact that you just lost a big percentage of your account. It's brutal. Welcome to this deep dive into the mechanics of candlestick charts in Forex, where we are specifically focusing on the most brutal, liquid market of them all, which is gold, or XAUUSD. It is definitely the most unforgiving. We have a massive stack of sources today. We're talking institutional trading guides, deep behavioral analysis of order flow, and the core mechanics of smart money concepts. And we are going to tear all of it apart. Because the goal today is to basically shift your entire paradigm. We are moving completely away from looking at candlesticks as these static, two-dimensional shapes or memorized patterns. No cheat sheets here. Exactly. We're going to decode them as a real-time visual diary of a constant, brutal war. A war between buying pressure and selling pressure, where literally billions of dollars change hands in fractions of a second. 2. The visceral reality of FOMO. So let's jump right into the visceral reality of that war, because every trader who has touched gold knows this exact feeling. You're sitting there, watching a strong green candle form on the chart. It's pushing higher. The momentum is just undeniable. And you start feeling it, right? You feel that entirely human rush of FOMO, the fear of missing out. You convince yourself that this is the big breakout you've been waiting for all morning, so you click buy. And almost the exact millisecond your order is filled, the market behavior just changes. It always feels like it knows. It does. That strong green candle stalls. It begins to shrink. The green color rapidly vanishes, leaving behind this thin vertical line, and the body turns into a massive, aggressive red spike plunging down and instantly taking out your stop loss. It feels incredibly personal. I mean, it feels like an algorithm was sitting there waiting for your specific lot size to enter the market just so it could reverse and take your money. It does feel that way, but we have to strip the emotion out of it completely. The market does not know you exist. Your retail position is a microscopic drop in an ocean of institutional liquidity. They aren't hunting your $10. Exactly. The chart is not trying to confuse you. It is simply logging the physical reality of supply and demand. But the problem is, most traders are looking at this logbook like they are trying to read a novel in a foreign language. They recognize the alphabet, they know what a green candle is, they know what a red candle is, but they have no idea what the syntax actually means. Precisely, they don't know the grammar. 3. Core anatomy, the body and the wick. Which brings us to the core anatomy. Now, our sources explicitly state that we are skipping the basic beginner stuff today. We have to. If you're listening to this, we're assuming you already know what an open, high, low, and close are. We aren't doing textbook definitions. We need to look at what those data points actually represent psychologically. So let's start with the physical meat of the candlestick, the body. The body of the candle is the ultimate measure of conviction. It is the physical representation of an imbalance in the market. Think about it like a live auction. If the price of an asset is going up, it means there are more aggressive buyers willing to pay higher prices than there are sellers willing to supply the asset at that current price. Demand is just crushing supply. Exactly. When we see a massive thick green body on, say, a 1-hour gold chart, it means that for 60 straight minutes, The buying volume was so overwhelmingly massive that it completely consumed all available sell orders at every single price level. It forces the price higher and higher until the hour ended. That is an extreme imbalance. It shows absolute dominance by one side. It's a footprint of heavy institutional participation because retail traders like us do not have the capital to create a massive imbalance on a 1-hour gold chart. Not even close. What about the opposite scenario? What if the body is tiny, like almost non-existent? That is a story of total hesitation, a stalemate, like a tie game. Exactly. End quote. End quote. The buyers stepped in and bought, the sellers stepped in and sold, but the volume on both sides was relatively matched. Neither side had the conviction or the capital to push the price significantly away from where it opened. The aggressive imbalance is just gone. That makes total sense for the body of the candle. It's the net result of the hour. But that doesn't explain the thin lines sticking out of the top and bottom, the wicks. Wicks represent rejection and exhaustion. They are the scars of a failed campaign. If I am looking at a 1-hour chart and I see a massive upper wick extending way above the body of the candle, what is the story? 4. The narrative of rejection. In the first half of that hour, the buyers were incredibly aggressive, pushing the price all the way up to the peak of that wick. It probably looked like a massive, dominant green candle at that exact moment in time. But then, they hit a ceiling. They walked into an ambush. At that specific high price, there was a massive wall of institutional sell orders waiting in the market. The moment the price touched those orders, the supply of gold drastically overwhelmed the demand. The buyers simply ran out of capital to absorb all those sell orders. They were exhausted. Then the sellers took offensive control, aggressively driving the price all the way back down before the 1-hour timer ran out. So that upper wick is literally the permanent visual record of that violent rejection. Exactly, it's a tombstone for the buyers. And understanding this dynamic shatters one of the most dangerous myths in retail trading, the idea that the color of the candle guarantees the direction of the market. The whole assumption that green means go and red means stop is such an incredibly costly simplification. It is lethal to an account. Imagine you're looking at a green candle, but it has a massive, towering upper wick that is 4 times the size of the body itself. A novice says, "It closed green, the buyers won the hour, I'm going long." But a professional looks at that exact same candle and reads a story of catastrophic failure because of the wick. The buyers tried to move the market up by 100 pips, and they were utterly crushed by the sellers. That is not a bullish candle at all. That is a profoundly bearish story of rejection. 5. 3 phases and liquidity traps. Candles are not signals. They are reactions to the underlying order flow. We read a sequence of these reactions in 3 distinct phases. Trending, momentum, large bodies, tiny wicks, institutional capital, flowing uninterrupted. Slowing, exhaustion. Shrinking bodies, growing wicks, profit-taking begins. Reversing, control shift. Aggressive candle in the opposite direction. Compression is another fascinating phenomenon. On the chart, it looks like a series of small, overlapping candles moving sideways. A novice thinks the market is dead, but beneath the surface, the market is coiling like a high-tension spring. When that tension finally releases, we get expansion, a massive breakout candle. But gold's favorite trap is the fake-out. The institutions intentionally engineer an initial breakout candle to create the illusion of a trend, triggering retail FOMO. As retail traders mash the buy button, the institutions are happily selling to them at a premium price. Once the positions are offloaded, the buying pressure evaporates, and the price violently reverses, leaving behind a catastrophic upper wick. They find the fuel they need in your stop losses. A stop loss on a long position is mechanically a resting sell market order. The institutions know exactly where those stop losses are clustered, usually just below an obvious support level. To fill their massive positions, they intentionally push the price down to trigger those stops. A cascading avalanche of retail sell orders hits the exchange, and the institutions absorb every single one of those panic sales. This is called a liquidity sweep. 6. Professional execution. The 4-step entry. Regarding market structure, boss break of structure requires a strong body candle to close entirely beyond the previous level. A wick is not enough. Choch, change of character, is the earliest warning sign of reversal. But don't let the noise of the 1-minute chart confuse you. You must obey the anchor of the 1-hour structure. Finally, the professional entry sequence requires 4 mandatory steps. Context. Price must be at a higher time frame key level, H4 or daily. Sweep. Wait for the trap to be sprung on everyone else. Shift. Drop to a lower time frame and look for a microstructural change of character. Inefficiency. Wait for price to pull back into a fair value gap to enter alongside the institutions. Never trade a candle while the timer is still ticking. You must wait for the final verdict of the body close. Patience is your only armor. Trade during high-volume kill zones like the London and New York Opens. The chart is a mirror. If you lack the psychological discipline to sit on your hands and listen to the story the candles are care, you will only see your own fear and greed reflected back at you, and the market will gladly charge you for the lesson.